the debate when it came to the bailouts and everything that took place, we heard a lot of talk about financial institutions being too big to fail. And my question to you all, each of you, is, is there, in our capitalist society, is there such a thing as an institution that's too big to fail? And how, if one of the very large financial institutions did fail, how would that affect you or your business or your clients, whatever the case may be? And I'll start with you, Mr. Harris.
I've listened to quite a bit to Mr. Geithner and Mr. Bernanke on that issue, and I happen to concur with both of them. That there are some institutions that were too big to fail and would have brought the world financial markets to a standstill if they did. I also understand what happened with those the ones that did fail, and what their limitations were at the time. It would have a tremendous effect. It's already having a tremendous effect, because right now most small businesses are having a very difficult time borrowing money with those same entities that didn't fail, but because they're having to go from a leverage model to a much lower leverage model than they were practicing. And these are the major banks that we all know that are still here today, but may be owned by someone else. I mean, I can give you a perfect example of a public hospital that I sit on the board of. And we were just forced to liquidate our endowment funds to pay off our bonds because we couldn't get the line of credits to secure those bonds we'd always been able to get with no problem. Now, we had the money to do it, but it'll put the hospital in a very tenuous situation. We are in a very tenuous situation in the event we continue to lose money because of Medicare cuts. And I happen to live in an area which is very high Medicare area. So it's already having that effect. I can tell you it's had that effect just with what's occurred on small business. Lines of credit and letters of credit are virtually impossible to get for small business.
Mr.
Loy. Thank you, Mr. Graves. So the way I would say what we do, because we invest in companies that often don't exist, and we help them start, we actually have been using a phrase of too small to fail. And the reason is these are the companies that are, a very small proportion of which are going to grow up to be the next Google, Cisco, Apple, Genentech, FedEx, Starbucks, et cetera. And we are quite concerned about the sort of opposite problem, which is that we're creating an environment in which it's too hard for those companies to get really big, particularly on the IPO side. And so they're choosing to sell out too early in order to get some money back to the investors. And typically when companies are acquired by other companies, including increasingly overseas companies making those acquisitions, they're not going to grow up to be the drivers of 12.1 million jobs that represent the last 30 years of venture investing. In terms of the impact of the Lehman, led crisis or another one, I think Mr. Harris's example is actually an interesting one. He mentioned that in order to get liquidity for their bond fund, they had to liquidate the endowment. The largest source of capital for our industry is actually endowments and foundations and pension funds. And we've seen a dramatic drop in their willingness or ability to provide capital to our industry because they're repurposing it away from higher risk, higher reward, but highly illiquid and long-term investments toward very short-term liquidity needs. And so I would characterize it as much as a timing problem as at any moment in time. The capacity and willingness to fund things for 5 or 10 years while they grow up to be those next generation drivers of job creation is seriously at risk, even as it is, and making it, adding more burdens onto us is sort of why we're particularly concerned at this critical moment.
Mr. Hirschman.
The right to fail in an orderly fashion has been one of the key strengths of our economy. Obviously, when everything fails at one time, it requires extraordinary steps. But I think one of the things we need to be careful is not to design our system so that there's an implied backstop by the federal government against the two largest mutual fund companies, the two largest hedge funds, or the two largest private equity firms, or the two largest of anything. And we need to be able to have the information at the regulator level to understand systemic risks, but not set anybody up to be permanently protected against failure. We can make them fail in a more orderly fashion so they don't burn down the whole neighborhood, but nobody should be insulated against failure.
Mr. Anderson.
I love your question. And I can tell, I don't know if you saw the Wall Street Journal a couple days ago, where it showed that 52% of all loan originations and closings happened by the top 3 companies. Where if you look at that 2 years ago, One of them was down to like 4%. That's dangerous. That's why I said in my opening remark that the small businesses are at risk. Do we want loan originations for home mortgages to be controlled by 3 companies in America? There have been an awful lot of choices for mortgages, a lot of small mortgage bankers who've done a phenomenal job, who never ever participated in subprime or pay option arms that got us in this mess to begin with. But a lot of these small companies can't get warehouse lines of credit, who did a very good job. My company, personally, we have the second lowest FHA delinquencies in the state of Louisiana, and we are at risk. So is a company too big to fail? I don't think so.
Mr. Robinson.
Congressman, it's hard to come up with the number, is how large is a company that it's too big to fail. I think more importantly, how much it's leveraged, how interconnected it is, and then in our business, how you manage your accumulations, or how much stuff do you have out there that could cause a problem. For example, as far as leveraging goes, our company is a mutual company. The only way we can raise capital is through operations. We don't issue stock. In our business, one of the leverage measures is premium to capital, or premium to surplus, which is a proxy for how many policies you write and how many exposures you have. In our business, 3 to 1, that is 3 times your capital, is probably the upper limit. 2 to 1 is much better. My company is under 1 to 1 because we're pretty conservative. I'm told some banks get up to 30 to 1. So the question really is, what is your leverage ratio? I think that's one point that's more important than an absolute size. The other question is how interconnected you are. What is your counterparty risk if either the counterparty or yourself has a problem? Our industry very rarely reinsures one another. When we buy reinsurance, it's kind of like laying off a bet. We usually go to the worldwide market. So there's not much interconnectivity in our industry. But it is something I believe you can measure. And then finally, what we call accumulation. That's how many houses do you insure on the beach, and how many businesses in an earthquake fault, along an earthquake fault line, and so on. That you need to be able to precisely measure that and report that to regulators to make sure that you haven't overextended yourself. So I think if you look at those 3 items instead of absolute size, you'd come up with a much better result.